Something has shifted in the silver market. Not overnight, not because of a single headline, but quietly, structurally, in ways that most investors are only beginning to recognize. If you hold silver, or if you've been watching it from the sidelines, this moment deserves your attention. Not because of panic, not because of promises, but because the conditions underlying this market have fundamentally changed, and understanding what that means could be the difference between opportunity and regret. I'm not here to sell you silver. I'm here to walk you through what's happening, why it matters, and what thoughtful investors are considering right now. This isn't about getting rich quick. It's about understanding a market that's been misunderstood for years and recognizing when the fundamentals finally begin to matter. Let's begin with what's real. For the past decade, silver has been quiet, overshadowed by gold, ignored by mainstream finance, treated as an industrial commodity with occasional speculative interest, but never taken seriously as a store of value or a strategic asset. That perception is now being tested by reality. Silver sits at the intersection of two massive global forces. On one side, it's an industrial metal, essential to solar panels, electronics, electric vehicles, and green energy infrastructure. On the other side, it's a monetary metal historically tied to gold, inflation hedging, and distrust of fiat currency systems. What's changed is that both sides of this equation are heating up at the same time. Industrial demand is accelerating as governments worldwide push renewable energy mandates. Monetary demand is rising as inflation persists, debt levels reach historic extremes, and confidence in central banking erodes. And here's the part most people miss. Supply isn't keeping up. Silver mines don't appear overnight. Primary silver production has been relatively flat for years. Most new silver comes as a byproduct of mining other metals like copper and zinc. When those industries slow, silver supply tightens, regardless of price. This is not a theoretical concern. It's happening now. Inventories at major exchanges have been declining. Premiums on physical silver have widened. Delivery delays have become common. These are not symptoms of a speculative bubble. They're symptoms of structural scarcity meeting surging demand. And yet, the price of silver remains historically cheap relative to gold, relative to its own production costs, and relative to the scale of money creation we've witnessed since 2020. That gap between reality and price is what makes this moment significant. Silver suffers from an identity crisis. It's not quite gold. It's not quite copper. It doesn't fit neatly into portfolios the way stocks or bonds do. And because it doesn't fit, it gets dismissed. Traditional financial advisors rarely recommend it. Institutions hold very little of it. Retail investors see it as speculative, something for gold bugs and doomsday preppers, not serious wealth builders. But this misunderstanding creates opportunity for those willing to think differently. Silver has always been volatile. It's a smaller market than gold, which means price swings are sharper in both directions. That volatility scares away institutions and casual investors, which keeps the market thinner and more prone to explosive moves when fundamentals shift. History shows that when silver moves, it moves fast. In 1979 and 1980, silver went from $5 to $50 in a matter of months. In 2011, it surged from $18 nearly $50 again, driven by fears of currency debasement and sovereign debt crises. Both times, the moves were dismissed as bubbles. And in some sense, they were. Speculative excess took over near the top, and prices collapsed. But what people forget is that those moves didn't happen in a vacuum. They happened because underlying conditions made silver scarce, and scarcity plus fear equals price explosions. We're not in 1980 or 2011. The conditions today are different. But the lesson remains. Silver is a coiled spring. It does nothing for long periods and then everything at once. Most investors misunderstand this. They see the quiet years and assume nothing is happening. They miss the slow accumulation of pressure beneath the surface. Let's talk about the world we're living in, because silver doesn't exist in isolation. It responds to the same forces that shape every asset: inflation, debt, interest rates, and confidence. Global debt is at record levels. Governments, corporations, and households are more indebted than at any point in history. That debt must either be repaid, defaulted on, or inflated away. Repayment seems unlikely given the scale. Default would collapse the financial system. That leaves inflation as the most politically palatable option. Central banks know this. They've spent the last 15 years trying to manage inflation expectations while printing unprecedented amounts of money. For a while, that money stayed in financial assets. Stocks surged, bonds held. Inflation remained subdued, at least officially. But something broke in 2020. Money printing went parabolic. Supply chains fractured. Energy prices spiked. And inflation, real inflation that people feel at the gas pump and the grocery store, returned with a vengeance. Central banks responded by raising interest rates, the fastest tightening cycle in decades. They insist inflation is under control now. But the data tells a more complicated story. Core inflation remains sticky. Governments continue running massive deficits, requiring continued debt issuance. And the political will to sustain high interest rates is fragile, especially as economies slow and unemployment threatens to rise. What does this mean for silver? It means the conditions that favor hard assets, tangible stores of value, are intensifying. When fiat currencies lose purchasing power, people look for alternatives. Gold is the traditional choice, but gold is expensive, harder to transact, and less accessible for average investors. Silver offers similar protection at a fraction of the cost, with the added benefit of industrial demand that gold lacks. This isn't speculation, this is pattern recognition. Every major currency debasement in history has led to a flight toward tangible assets. We're in the early stages of that process now. Let's get specific about supply, because this is where the crisis becomes undeniable. Silver comes from three main sources: primary silver mines, byproduct production from other metals, and recycling. Primary production has been flat or declining in recent years. Byproduct production depends on the health of copper, lead, and zinc mining, which faces its own challenges from permitting delays, rising costs, and environmental restrictions. Recycling helps, but it's a limited source. Unlike gold, most silver is consumed in industrial applications. It's used in tiny amounts per product, spread across billions of devices, making recovery uneconomical in most cases. Once it's used, it's gone. Meanwhile, demand is surging. Solar panel installations are growing exponentially. Electric vehicles require more silver per unit than traditional cars. Electronics continue proliferating. And now, after years of indifference, investment demand is returning. Exchange-traded funds that hold physical silver have seen inflows. Coin sales from government mints have hit multi-year highs. Retail investors, burned by stock market volatility and distrustful of traditional finance, are buying physical metal at a pace not seen since 2020. This creates a mismatch. Demand is rising faster than supply can respond. And because silver supply is relatively inelastic in the short term, meaning you can't just turn on new production overnight, the imbalance builds. Inventories act as a buffer, but they're not infinite. When inventories fall to critically low levels, markets can dislocate. Prices can spike not because of speculation, but because there simply isn't enough metal to satisfy demand at current prices. We're approaching that threshold now. Not tomorrow, not next week. But the trajectory is clear. History offers lessons here, not just in silver, but across commodity markets. When a commodity becomes genuinely scarce, not artificially constrained, but structurally undersupplied, markets don't respond gradually. They respond violently. Think about oil in the 1970s. The price didn't rise steadily as demand exceeded supply. It exploded in sudden shocks, catching governments and investors off guard, reshaping entire economies. Think about uranium in the mid-2000s. Years of underinvestment in mining created a supply deficit. When utilities realized they didn't have enough fuel for existing reactors, the price went from $10 per pound to over $100 in less than 2 years. Silver has shown this behavior before. In 2010 and 2011, the price more than doubled in a matter of months, not because of a sudden change in industrial demand, but because investors woke up to the idea that silver was undervalued and undersupplied. The difference now is that industrial demand is real and accelerating, not just speculative fear. That adds a floor beneath the market that didn't exist in prior cycles. When both investment and industrial demand align, when physical tightness meets monetary anxiety, markets can move in ways that seem irrational to those who aren't paying attention. But they're not irrational. They're the market adjusting to reality after years of mispricing. If you're someone who has held silver through the quiet years, through the mockery and the doubt, this is the environment you were waiting for. But waiting isn't the same as winning. What matters now is discipline. First, understand that volatility will increase. If you thought silver was choppy before, the moves ahead could be sharper in both directions. This is not a market for weak hands or emotional decision-making. Second, resist the urge to sell too early. One of the biggest mistakes precious metals investors make is exiting positions at the first sign of profit, only to watch the real move happen without them. If the thesis is structural shortage and currency debasement, then the move hasn't even begun yet. Third, have a plan. Know your goals. Are you holding for wealth preservation, for speculation, for generational transfer? Your timeline and risk tolerance should dictate your actions, not the daily price swings. Fourth, consider the difference between paper silver and physical silver. Exchange-traded funds and futures contracts offer exposure, but they're not the same as holding the metal. In a true supply crisis, physical delivery could become problematic. If you believe in the scarcity thesis, owning the actual metal provides a level of security that paper claims cannot. Fifth, don't overconcentrate. Silver is a tool, not a religion. It should be part of a diversified approach to wealth building, not the entirety of it. Prudence matters more than conviction. If you hold silver now, you're positioned for what could be a historic revaluation. But positioning is only the beginning. Managing that position through volatility, resisting fear and greed, and staying committed to your strategy, those are what turn potential into reality. If you're watching from the sidelines, wondering whether it's too late, the answer depends entirely on how you think about risk and opportunity. Is silver higher than it was 5 years ago? Yes. Is it higher than it will be 5 years from now? No one knows. But if the structural case is sound, if supply deficits are real and monetary instability is rising, then current prices could look inexpensive in hindsight. The mistake most people make is waiting for certainty. They want confirmation that the move has already started before they act. But by the time everyone agrees, the easy gains are gone. Smart investors think probabilistically. They ask, what's the downside if I'm wrong? What's the upside if I'm right? How much should I allocate to express this view without jeopardizing my financial stability? For silver, the downside is limited. It's a tangible asset with industrial value. It's not going to zero. The upside, if scarcity and monetary fear converge, could be multiples of current prices. That asymmetry is what makes it interesting, not guarantees or certainty. If you choose to enter this market, do it thoughtfully. Don't chase. Don't buy on emotion. Don't allocate more than you can afford to hold through volatility. Start with education. Understand what drives silver prices. Study past cycles. Learn the difference between spot prices, premiums, and delivery logistics. Know what you're buying and why. Then, if it makes sense for your goals and risk profile, begin building a position gradually. Dollar cost averaging reduces timing risk and emotional pressure. Buying physical metal from reputable dealers ensures you own what you think you own. And once you've entered, have the patience to let the thesis play out. Markets don't reward impatience. They reward those who can withstand discomfort and stay the course when others panic. Let's talk about what happens in your mind when markets move. Fear and greed are not abstract concepts. They're biological responses that override logic. When prices rise, greed whispers that you're missing out, that you need to buy more, that this time is different. When prices fall, fear screams that you're losing everything, that you need to sell before it gets worse. Both emotions destroy wealth. The investors who succeed in volatile markets are not smarter or better informed. They're more disciplined. They decide in advance what they'll do in different scenarios, and then they execute that plan regardless of how they feel in the moment. This is especially important in silver, where price swings can be violent and narratives shift rapidly. One week, the financial media will declare silver the best trade of the decade. The next week, they'll call it a relic with no future. Neither story is true. Both are noise. Your job is to filter noise from signal, to focus on fundamentals, not headlines, to trust the process you've built, not the panic or euphoria of the crowd. This requires emotional distance. It requires humility. It requires accepting that you don't know what will happen tomorrow, but you do know that preparation and patience compound over time. If you can cultivate that mindset, you'll outperform not just in silver, but in every aspect of investing. Let me be very clear about the mistakes you must avoid. Do not react emotionally to price movements. Silver will fluctuate. That's its nature. If you panic and sell during a dip or chase recklessly during a spike, you'll destroy your returns. Do not over-leverage. Some investors use margin or debt to amplify their positions, thinking they can time the market perfectly. This is gambling, not investing. Leverage turns manageable losses into catastrophic ones. If you believe in silver, own it outright. Do not blindly follow online hype. Social media and forums are filled with people screaming about silver squeezes and imminent explosions. Some are sincere, some are misinformed, some are trying to manipulate prices for their own benefit. Think for yourself. Verify claims. Trust data over narratives. Do not ignore taxes and costs. Buying and selling physical silver involves premiums, storage, insurance, and in some cases, taxes on gains. These costs eat into returns. Factor them into your decisions. Do not confuse volatility with failure. If silver drops 20% in a month, that doesn't mean the thesis is broken. It means markets are volatile. Stay focused on the long term. And most importantly, do not risk money you can't afford to lose. Silver is not a savings account. It's not a guaranteed return. It's a strategic allocation within a broader financial plan. Treat it accordingly. Silver has been money for thousands of years, longer than any fiat currency, longer than most governments. There were times when silver was more valuable than gold, times when entire economies ran on silver coinage, times when wars were fought over access to silver mines. The history doesn't guarantee future performance, but it does provide perspective. Silver is not a new invention. It's not a speculative toy. It's a foundational element of human commerce and wealth preservation. In the 20th century, silver was demonetized. Governments removed it from currency. Central banks stopped holding it as reserves. It became, in the eyes of modern finance, just another industrial commodity. But demonetization didn't eliminate silver's monetary properties. It just suppressed them. And when trust in fiat systems erodes, those properties reemerge. We've seen this pattern before. In Weimar Germany, when hyperinflation destroyed the Reichsmark, people hoarded tangible assets. In Argentina, When repeated currency crises wiped out savings, citizens turned to dollars, gold, and silver. In Venezuela, when the bolivar collapsed, bartering and hard assets became the only reliable stores of value. These aren't ancient stories. They're modern examples of what happens when monetary systems fail. The United States and Europe aren't Venezuela, but the forces at work, debt, deficits, inflation, eroding trust, are universal. They don't respect borders or exceptionalism. Silver remembers what governments forget, that value can't be printed, only transferred. No one can time markets perfectly. Not professionals, not algorithms, not gurus. Anyone who claims they can is either lying or delusional. What you can do is position yourself intelligently based on probabilities and risk management. If the probability of a silver shortage is rising, if monetary instability is increasing, if industrial demand is accelerating, then holding silver makes sense even if you can't predict exactly when the move will happen. This is how insurance works. You don't buy fire insurance because you know your house will burn down next Tuesday. You buy it because the cost of being wrong is catastrophic and the cost of being prepared is manageable. Silver functions similarly for portfolios. It's insurance against currency debasement, financial instability, and supply disruptions. It may sit quietly for years, but when it's needed, its value becomes undeniable. The key is to position before the crisis, not during it. Once everyone sees the problem, prices have already adjusted. The opportunity exists in the gap between reality and perception. Right now, that gap still exists. Most investors don't believe in a silver shortage. Most don't fear inflation despite the evidence. Most trust central banks to manage the system smoothly. That trust may be well-founded, or it may be misplaced. Either way, those who position thoughtfully today will be better prepared than those who wait for certainty. Patience is not passive. It's an active decision to endure discomfort in pursuit of long-term gain. In silver markets, patience means holding through corrections that shake out weak hands. It means ignoring the daily noise and staying focused on the structural thesis. It means accepting that you might be early, and being early often feels the same as being wrong. But early is not wrong. It's the price of positioning before the crowd. Think about investors who bought gold in the early 2000s. They endured years of skepticism, mockery, and flat prices. Then, from 2005 to 2011, gold went from $400 to $1,900. Those who stayed patient were rewarded. Those who sold in frustration missed the move. Silver could follow a similar path. The setup is there. The fundamentals are aligning, but the market moves on its own timeline, not yours. Your advantage is that you can choose to wait. You can choose to hold through uncertainty. You can choose to let the thesis unfold rather than demanding immediate validation. That choice, that discipline, separates investors from speculators. If you hold silver, or plan to, you should understand exactly what you own and why it matters. Physical silver, coins, and bars offer the most direct exposure. You own the metal. You control it. You don't rely on counterparties or financial institutions. In a crisis, physical ownership matters. Silver ETFs provide liquidity and ease of trading, but they're not the same as physical ownership. They hold metal on your behalf, in vaults you've never seen, with legal structures that may or may not guarantee delivery in extreme scenarios. They're useful for trading, less so for long-term wealth preservation. Mining stocks offer leverage to silver prices, but they come with company-specific risks. Management, production costs, geopolitical exposure. All of these factors affect returns independent of silver prices. Good miners can multiply gains. Bad ones can destroy capital even as silver rises. Futures and options are for sophisticated traders only. They offer powerful leverage, but also the risk of total loss. Unless you fully understand how these instruments work, they're not appropriate for most investors. Know what you own, know why you own it, and know the risks specific to that form of ownership. Silver doesn't exist in isolation. It's part of a broader shift happening across financial markets. Bonds are losing their safe haven status as inflation erodes real returns. Stocks face valuation challenges after years of easy money and multiple expansion. Real estate is unaffordable for many and vulnerable to interest rate shocks. Traditional portfolios, 60% stocks, 40% bonds, are struggling to deliver the returns investors expect. That's forcing a rethink of asset allocation. Alternatives are gaining attention. Private equity, venture capital, real assets, commodities. Investors are searching for uncorrelated returns, for hedges against inflation and systemic risk. Silver fits into that search. It's an alternative to traditional finance. It's uncorrelated to stocks and bonds over the long term. It's a hedge against both inflation and deflation, though for different reasons. In inflationary environments, silver preserves purchasing power. In deflationary crises, it benefits from safe haven demand and potential monetary interventions that follow deflation. This versatility makes it valuable in an uncertain world. Every market cycle is both the same and different. The same emotions drive behavior. The same patterns repeat. But the specifics always vary. What makes this moment unique is the convergence of forces that have never aligned quite like this before. We've never had global debt at these levels while facing green energy transitions that demand massive amounts of silver. We've never had central banks printing this much money while industrial supply chains remained this fragile. We've never had retail investors this connected, this informed, and this distrustful of traditional finance. The internet has democratized information and access. Retail investors can buy physical silver as easily as institutions. They can coordinate, share research, and move markets in ways that weren't possible decades ago. This doesn't guarantee a silver explosion, but it does change the dynamics. It means demand can emerge faster and more forcefully than in past cycles. Combine that with structural supply deficits and monetary instability, and you have conditions ripe for repricing. Not certain, not guaranteed, but probable enough to warrant serious attention. Smart investors prepare for multiple outcomes, not just the one they hope for. If silver rises sharply, have a plan for taking profits. Don't ride it all the way up and all the way back down. Lock in gains incrementally. Rebalance as positions grow too large relative to your portfolio. If silver stagnates, be patient. Review your thesis periodically. If the fundamentals remain intact, time is on your side. If something has changed structurally, be willing to adjust. If silver falls, don't panic. Ask why it's falling. Is it a temporary correction? A shift in fundamentals? A broader market sell-off dragging everything down? Your response should depend on the cause, not the direction. Flexibility matters more than stubbornness. The market doesn't care about your beliefs. It cares about supply and demand, fear and greed, liquidity and leverage. Adapt to what is, not what you wish it to be. Read about silver's history, study monetary systems, learn how commodities markets function, understand the difference between paper and physical metal, between spot prices and premiums, between investment and speculation. Follow credible sources, not hype merchants. Verify data, question narratives, think critically. Education reduces fear. It builds confidence. It helps you recognize opportunity when others see only risk. This isn't about becoming an expert. It's about being informed enough to think independently, to resist manipulation, and to act with conviction when the time comes. We stand at a crossroads in financial markets. The old assumptions that central banks control everything, that fiat currencies are stable, that asset prices only go up, are being tested. Silver is one lens through which to view this shift. It's not the only lens, but it's an important one. What happens next will depend on forces larger than any individual investor. Governments will make decisions. Central banks will react. Markets will fluctuate. Narratives will shift. Your job is not to control those forces. It's to position yourself intelligently within them. If you hold silver, stay disciplined. Manage risk. Don't let volatility shake you out of a sound long-term position. If you don't hold silver yet, consider whether it fits your goals and risk tolerance. If it does, act thoughtfully. If it doesn't, that's fine too. Not every opportunity is right for every investor. What matters most is that you understand what's happening, why it matters, and how it might affect your financial future. The crisis isn't coming. It's already here, unfolding slowly beneath the surface, waiting for the moment when perception catches up to reality. When that moment arrives, those who prepared will be ready. Those who ignored the signals will be caught off guard. Be ready. Stay informed. Think long term. And remember that, in markets, as in life, patience and preparation compound in ways that panic and reaction never can. Thank you for your time and attention. This is a moment that demands both